Welcome, everyone. So I've got a lot of questions about Tesla, and I'm sure you do as well. So the good news is we have James Stephenson with us this morning, this almost bright, sunny morning, and we're going to ask him a lot of questions. Is the stock price of Tesla underpriced? Is there some sort of trend line that we can look at to see and compare whether or not it's underpriced or overpriced today? He just recently released his detailed forecasts on gross margin, cash, revenue, vehicle productions. We also want to look at this unique pattern that we sometimes see with the Tesla stock. We see that it reaches its all-time high in the second half of the year. I would love to get his opinion if he thinks that that is true or something that is just a made-up pattern that we're looking at. So welcome, James. Appreciate you being able to join us this morning.
Hey, good morning, Herbert. Thank you for having me on your channel. I appreciate the invitation.
Yeah, I think I always ask people if they're ready to get brighter, but I think today they're not only going to get a little brighter, they're going to get a lot brighter.
You're too kind.
Yep. Well, it's not just me. So one of the very cool things about you, James, is that when Elon Musk was asked who is his favorite retail Tesla analyst, he named you.
Well, that's you're kind to phrase it that way. I was trying to make a joke in my tweet. It's my pinned tweet. If you go check out my Twitter account at @ICannot_enough. He was telling people what his son Saxon's middle name was and said James. Right. So I retweeted that, asking the question, "Hey Elon, who's your favorite retail analyst?" But then he did reply.
Oh, it's hilarious. Yeah.
And I had a mug made of it.
Oh, I would do the exact same thing.
He replied to me, "You're pretty great." So
you're pretty great.
That was more than I could have expected from my dumb little joke.
Yeah. I would make a mug. I would make a T-shirt. That's hilarious. And I would pin it like you are. But it is
my Elon cool T-shirt on here.
Yeah. Not only did he reply to you and say that I agreed that you're one of his favorite, but you are having regular conversations with him. Just 2 days ago, you made a comment about some sort of automated side mirror, and he started to go back and forth in a Twitter conversation with you. I thought that was absolutely pretty cool. It wasn't just a quick comment.
Yeah, it was pretty cool. I have been extremely fortunate over the years to have received a bunch of replies from Elon for no good reason that I can tell. I've never met him before. He just interacts with strangers on Twitter a lot. And,
I think, what's unique about you, of course, is that you're not just making comments. You are one of the few that have very, very detailed reports, analysis, estimates, forecasts. You really, really do a good job of doing that. So if you haven't already following, you need to follow James Stephenson, and he has a unique Twitter name. I cannot underscore enough.
Yeah. The story behind that handle is that I heard somebody use the expression on an NPR interview on my drive into work one morning. I was like, I bet somebody has that on Twitter because you're only allowed to use letters and underscores. So I wanted to go check out what cool person has already taken @ICannot_enough. And it was available, and I couldn't believe my luck.
Yeah, so I said, well, I'm taking it. What cool person would think that that's so cool?
Yeah, I said, I'm going to be that cool person.
I cannot underscore enough. I mean, it's too witty. It's too meta, maybe. I don't know.
It's maybe too hard to figure out. A lot of people who've been following me for years will reply, I can't believe I only just figured out that I cannot underscore enough is a pun.
Yeah, it takes a while. Okay, well, let's get deep right into the detailed analysis. And let's start with the Stephenson Indicator. Let's put it up here. Oop.
All right.
Let's do that. And I know you've positioned this before, that it's a bit of a fun. It's not something people necessarily have to take seriously. It's just one more metric, but it's a cool thing that you discovered, and people can kind of take it for what it is. And so I'll just give you, from a layman's perspective, what I understand it to be, and then you can correct me and go deeper into this. But I love this stuff. I love it because many of us are very heavily invested in Tesla. We think of it as a significant company. We think that it has significant growth. And so we're watching the stock price. And we notice that the stock price doesn't always connect with the fundamentals. We get that. But we know that if a company continues to just be an earnings machine and just grow 50% per year, like Tesla has been doing and is going to be about to do continuously, that the stock price should follow. So what I think you've done here was you looked at the previous years and you noticed that the stock, while it goes up and down, you notice that there's this general trend line of where it kind of follows along quite nicely. And so what you've shown here is that trend line over time. And then these bar graphs are at the top of it would be the stock price as the dates go along. And so what I see here is that in the last several years, the stock price is overpriced over what it should be based on that trend line. And then recently it's underpriced. I'm probably not doing a good job of explaining this, but go ahead.
Yeah, well, it's hard to explain. It's so hard to explain that I actually made on my YouTube channel, James Stephenson, which I named after myself, egotistically.
You didn't actually do that. Videos. You didn't do that. It was our friend Mayor that did that, and then you thought, okay.
Oh, yeah, he did. Yeah. So at Fresh Jiva on Twitter, Mayor Thaker said you should trademark it, Stephenson Indicator TM, which I thought was hilarious. Just the first time that I pointed out, hey, there is this technical analysis support line, which is just a dumb linear function, right? It's just the lowest price at which Tesla has closed since 2019. So that happened on March 18th of 2020. It was $72.24, split adjusted. So actually in August 31st of 2020, Tesla split 5-for-1. So it was more like $361 and change
at the time
on that date at that time. But you have to adjust it for the split after it happens. So in today's prices, it was $72.24. And I have to say that really fast because Tesla is about to split again 3-for-1 next week, which I have already reflected in my forecast model, but I'll keep going before I get lost. So if you take that date's closing price, $72.24, and you add $1.69 to the stock per trading day cents, you get the line that you see first when you look at this chart, that diagonal line. And the coolest part about this chart is that diagonal line does not exist. There's no diagonal line drawn on this chart. All of the lines on this chart are either horizontal or vertical, right? And so all those vertical white lines are showing you the distance between that day's actual closing stock price and Stephenson Indicator, which is just that line function that I described. So for every day, how far above or how far below Stephenson Indicator did Tesla's stock close is all this is showing you. So during that epic bull market that lasted 2020 and all of 2021, for most of the time, this support line this function acted as support for Tesla stock, if you look back at it. And then this year, 2022, when we've had a pretty big bear market the whole year, Tesla has mostly traded below Stephenson Indicator and has started trending back up towards it recently. So one of the questions I get about this is this a joke? Yes, it's a joke. Stephenson Indicator, like all technical analysis, should not be trusted for anything. It's only showing you what has happened. It is no guarantee of future results, and this is not trading advice, and we're not providing financial advice to anyone. This is for entertainment purposes only, everybody.
Yeah. It's one additional metric, right? And so does that $1.69 number, is that somehow correlated with the earnings and the growth earnings that this particular company is showing for the last several years?
Yeah, so where did it come from? It just came from looking at the trend, eyeballing it, and seeing, hey, where has support been? What number would you need to plug in there to get to support? And it was close enough to $1.69 that for meme purposes, I rounded it to $1.69.
Nice.
To be funny, the same way Elon does a lot. Thank you for the nice. But in my series of videos on Stephenson Indicator, by the time I get to part 3, I explain what fundamentally about Tesla explains this increase in stock price over time. And what that is earnings growth. The market is forward-looking, and when Tesla's earnings grow and when estimates from the analysts go higher for what future earnings will be, the stock price goes higher with those higher price targets. So really, it is Tesla's fundamental earnings growth driving price appreciation over time, which explains why we see a function like this.
Okay, exactly. Okay, so that's what I assumed it was, and I get the fact that this is not to be taken seriously. I get that because we're making up numbers. Okay, you imaginary line kind of thing, but it is important to actually visualize somehow this notion, the notion that we know that Tesla is spitting out earnings, and we know that they're growing significantly per quarter. And yet the stock price is frustratingly not following with that growth. And that's understood. We understand that stock price and fundamentals are, they're not necessarily connected, but they are connected in the long term. So if you look at it from years perspective, we all say this, right? Okay, look at it 2 years, 3 years from now. I tell my family and my friends that I get that the stock can skyrocket and can fall. It's very volatile. It's a beta stock, but it cannot be ignored that 3 years from now, based on the cash flow and the earnings that this company is going to do, that they're going to, the stock price can't follow. And this is kind of a visualization of that, right? That this is the showing that if you keep growing and you keep increasing your earnings, the stock price, it needs to keep going up.
Yeah, either it'll go up or it'll be good news for people who have money they want to invest in Tesla stock because they'll be able to buy more shares for their money. Eventually, the price has to catch up or else the PE will get too cheap for a company that's growing earnings that quickly.
Keep doubling each year.
A guy named Peter Lynch, who was very good at investing, said that the PE can be high and that still be a good deal if the earnings growth rate is also high. And if the risk of achieving those earnings is low, then you ought to be okay paying a higher PE for a stock that has much higher growth and, future earnings potential than other stocks.
Yeah. And so what this graph is showing is that for many years, the stock price of Tesla is actually overpriced, rightly so, because of future perspective, looking at the future growth. But even recently, it's way underpriced. And so not financial advice, but this chart is showing that, when it gets back up to, people start looking in the future again, forecasting the future and pricing the stock a little bit more closely to that, it should reverse back up. So
yeah, my expectation for the future is that in 10 years, people will look back at these prices for Tesla with a market cap under $1 trillion and say, wow, what a great buying opportunity it was back then.
Wow. Okay. This means a lot when you say it, because I know that you're not like the others, like me, who are armchair folks who say these kind of statements. You actually have very, very detailed forecasts. And so let's get to that. I'm very, very fortunate. I know that you have a Patreon account and only those members are able to see and release look at your most recent information and data, which is very valuable. You just released it yesterday. Just because I scheduled today this meeting with you, I get to peek at it early. Thank you for that. Let's get to the vehicle production. And do you have a forecast for that in the next several quarters? And
I've got a few different ones. Let's see here. So this is deliveries and not production. Let me make this bigger. And when I do that, is that showing you my presenter view or is that showing you the display? Is that better or is this better?
That's better. That's much better. Thank you.
Awesome.
Yeah, do that.
So what I do is a very detailed forecast Some would say an unnecessarily detailed forecast. A lot of people would. So I'm one of the very few people who does forecast this detailed. I'm not aware of anybody who does a more granular forecast for Tesla than I do. Now, that doesn't make mine more accurate than everybody else's, but I feel better having a very detailed forecast because it gives me confidence that I'm not going to forget about something that I knew was a business dynamic in play that would impact the income statement, but I just forgot about it or didn't include it in some bottom line number. I used to do a really high level forecast, and my variances were larger than I wanted.
Yeah.
So I threw it out completely, and I started with a ground up build of, hey, if I were going to be doing this at my job, I've been a financial analyst for 20 years and working for Fortune 500 companies. I have an MBA and a business degree. So I'm very comfortable working in Excel, and I just imagined, hey, if it were my job to plan Tesla's income statement, how would I do it at work? So that's what my detailed forecast model does. What this chart shows is just the breakdown by model for each of the vehicles Tesla produces. And you can see 2022, right about the center of the screen, this big dip is the quarter that we just had. And you can see visually on the screen why we had that dip. Which of these areas got pinched? It was the yellow one and the red one, right? So the Shanghai Model Y and the Shanghai Model 3 are the vehicles that dropped in production or in deliveries in Q2 of 2022, and it's because of the Shanghai lockdowns that happened in April and May. So every analyst should have seen this coming before the Q2 earnings were released and updated their models accordingly. That's one of those force majeure events that Elon talks about sometimes. Unexpected, idiosyncratic stuff that you cannot prepare for or plan for that just happens in real life. So that was one of them that negatively impacted Tesla's deliveries in Q2 of 2022. But you can see that going forward, as Tesla ramps Berlin and Texas, there's going to be a lot more Model Y in the short term. And then over the long term, a lot more of everything.
A couple questions.
Sure.
Me, I'm a little distracted here because I'm looking at your Cybertruck and Semi, and they look a little small compared.
They do.
Maybe I'm wrong.
So Cybertruck doesn't start until middle of next year, is what Elon said. So expect those to start with a small ramp and get bigger over time. I mean, when we say they look small, talk about expectations and comparisons. Well, what are we comparing against? We're comparing against Fremont, which is here. This is 500,000 vehicles per year. This is the number one volume production factory in North America, the Fremont factory. And that's just from here down, right? Out in 2025, this is what I'm projecting Fremont is going to do. So this doesn't look like a very big area, but it's just in comparison to how much Shanghai is going to be producing between all the vehicles that they can produce at their current facility and at a new one that they're building. That one looks a lot bigger. Yeah.
The reason is because it's only till 2025. Not that it's only, but it's like very, very, the forecast is very clear to next year and the next year and the next year. And that's why, reason I say that it looks like it's a small number, because I'm expecting Cybertruck to be 1 million and Semi to be 1 million at some point. But you're much more accurately saying it will, but it'll take many years.
What I have as my expectation for Cybertruck here is about 100,000 per quarter by the end of Q4 2025.
That's fair.
So that would make it, 500,000 vehicles per year. That's not a slouch. That's going to be one of the world's best-selling vehicles at that point in time. It just looks small against every other model Tesla will be producing around the world.
Okay, it's per quarter, and it's only 2-3 years out. There you go. That explained everything. And Semi, it looks like a tiny little light, and I'm thinking, probably, I'm hoping maybe 20,000 for next year? What's the actual numbers?
Well, for a vehicle like Model Y, that's a midsize, crossover SUV, that's the most popular kind of passenger vehicle in the world.
Mm-hmm.
So you can sell millions of those per year. Model 3 as a luxury sports sedan, you can sell 1 million of those per year. Semis are not the same kind of vehicle, and they look small by comparison when you put them on a chart like this. But there just aren't as many of them to begin with. There aren't as many semis purchased per year. Now, Tesla can beat this forecast. I know you're looking at it saying, they better beat that. That looks really small. But, I think they're called Class 7 tractors that pull heavy trailer loads, at least in the U.S. There's not a market to sell 500,000 of those per year because there aren't that many being purchased. There's a fleet that already exists, and those vehicles last for 10 years or however long they last, their lifespan is. So you're only replacing a tenth of that fleet per year. It's not a giant market, but it is a big profit opportunity for Tesla because of the operating cost savings that those semi buyers will experience with much lower fuel costs. And if Tesla nails FSD, a lot of labor savings. Those are your chief two costs related to the shipping and trucking business are labor and fuel. If you can greatly reduce both of those of your two biggest costs, that's great for your P&L. So the payback period on a Tesla Semi should be short.
Yeah. $200,000 per 3 years savings is what they said, just on the fuel.
Yeah. So how much do you charge for that? I think Tesla's going to raise the price of the Semi, which we saw changes to the website recently. So I don't think they want to let anybody else reserve semis at the launch day pricing.
Nice. Okay, let's move on. What's your next, which one do you want to do next? Earnings, gross margin, my favorite, cash.
Let's see. I've got a whole bunch of charts here. I'll flip through quickly. So here's non-GAAP earnings per delivery. Okay. We can talk about this one.
Why do you do it by per delivery?
Well, so if it's just a number, if it's just a dollar amount, that's okay. And that's how Tesla reports it. And you can go look at the number getting bigger over time. But what's also important is to realize that Tesla is getting operating leverage with scale. So the more vehicles you produce, the more revenue you make. Even if your gross margin doesn't improve, your earnings per delivery will increase because you're flexing against your fixed cost base. So your headquarters doesn't have to hire twice as many people to work there if you produce twice as many cars globally as you used to, right?
Can you pause?
Sure.
I'm a layman. I've got an MBA too. I'm very good at finance, but I just need to pause because you said a lot of things there just for a second. So I had always, I guess, naturally assumed that earnings can grow if you cut the expenses and become much more efficient. What you're saying is that even if the capital expenditure has already happened and stuck, if the revenue keeps going up, they can produce that car.
Yeah, so these earnings per vehicle, the primary reason that they're able to grow to these much higher volumes over here, so much higher dollar amounts per vehicle, is because of software. It's because of FSD, and it's because of being able to charge more for it as the feature set improves and as driverless becomes a reality. So I'm expecting that to happen toward the end of next year, and for the price to increase steadily between now and then. That's where most of this earnings growth is coming from.
Okay. Yeah, that I get. Okay.
Yeah, but the principle holds that your company, when you start off, is going to lose money.
Right.
If you're trying to get into the auto manufacturing business, until you are able to ramp your volume level to at least be able to produce as much gross margin as you have operating expenses, you can't produce a profit. You've got to get to that break-even volume. And then once you get to it, if you continue to accelerate production growth and deliveries growth beyond that point, you're going to continue getting more earnings per delivery as your worldwide sales grow.
I love it. Yeah, you know, what'd be really interesting is, and you might already done this, is do it by factory, and you show me when does GigaTexas in Berlin, at what delivery number do they then become earnings and profitable, and, you know.
Oh, I've got it.
Oh gosh, I've been waiting for this, because it's interesting for Elon to say that these are cash burning factories today. They're losing millions a day. And then I then naturally ask, how many cars do they need to produce per week before you'd consider them at least break even and then, you know, skyrocketing up?
Sure. Yeah. So what I have here is a whole lot of numbers.
Yeah.
So these are gross margin percentages. So I've got them for every product that Tesla makes, for each model, for each site.
Okay.
For the energy products, for each one of those, and for the services and other line. And I've got the regulatory credits on here as well. So does Tesla provide this level of detail? No, they don't. I never get to find out how accurate my forecast was in detail. But as time goes by, I try to play detective, put my Sherlock Holmes hat on, and try to figure out, okay, there was a miss this quarter. How did Tesla explain that miss? And where do I adjust what I had forecast to get it to what my forecast should have been to produce the correct numbers? So I'm doing that process every time Tesla reports quarterly earnings. I'm going back and fine-tuning my model. So what you see here on rows 1530 through 1564 of my detailed forecast tab are just the output of how much gross margin you're making per vehicle. So here we see in 2021, there was a negative gross margin on Fremont Model X's because they weren't at break even.
Wow.
They were producing so few and delivering so few Model X's, they couldn't produce a profit on that vehicle at sales volume that low, right? So this is what was in my forecast. Do I know that each of these numbers is deadly accurate? No, I don't. But that's what was in my my detailed build. And I'll scroll to the top to show you what I mean when I say that. So I've done videos before where I walk people through this detailed model, but for every site, I go through each of the models that are built at that site, and I figure out what the weekly production capacity is for that vehicle, how many weeks they were producing vehicles, and how productive they were on average over those weeks in that quarter. And that gives me production. Then from there, I have to figure out how to reconcile the ending and beginning inventories to get to the vehicle deliveries. How many could they have delivered during that quarter?
Love it.
And I've also got the leased vehicles count here because you need that to be able to build up to the income statement. And Tesla does report that, but they don't report it at this level of detail. So you do that for every single vehicle. So there's the 5 that Fremont will produce. At Shanghai, I've got Model 3, Model Y, and a future vehicle that I'm calling a Shanghai Robotaxi here.
Yeah. Let's get to Texas. Yeah. Okay, go ahead.
So for Berlin, they're producing Y now. They are rumored to produce Model 3 in the future, and maybe they will have another vehicle. I've got a placeholder here for a European model.
Oh, okay.
At GigaTexas, they're producing Model Y now. They will produce Cybertruck and Semi, which may start production in Nevada and then move to Austin. But they have a really big factory already that could accommodate semi-production if they wanted. So that's how you get to the total production and deliveries. I've got that by site here, so totaled up for each site. And then below that, once you've got all that squared away, then you have to figure out, okay, how much revenue is there per vehicle? I've got that broken down by option type, by vehicle, by site. So for all of the decisions that face buyers of Teslas on the website when you go to the vehicle design studio to
James.
figure out what Tesla you want. What are the options people are picking? What's the take rate on each option? And what was the price in that quarter for that option? So I'm building up from there using assumptions about take rates and prices to get to total cash buyer ASP, and then to make the adjustments that get you to total revenue per vehicle. So after those, you need to figure out what your cost of sales is. And then there's also the energy segment that you need to forecast revenue for. So you've got, factors like solar deployed, storage deployed, revenue per watt, stuff like that. And then the number of units that you want to sell for each of these. And you get to the cost of sales, which I'm also doing the same way I do the revenue. So it's how much does each of these options cost Tesla to produce by option type, by vehicle, model, by site. And then once you have those, you can build the top of the income statement. So that's here. All of that work is to get down to that line of the income statement.
Wow.
I do 1,160 rows worth of detailed calculations to figure out what these 15 rows are going to be.
Yeah, this is detailed. This is very detailed. I doubt even, like you said, that they might not even have this all in one, analysis.
I doubt Tesla has something just like this. Right. Maybe I'm wrong and they do, but yeah. And then you have to forecast other stuff. So below the line costs, research and development, SG&A, restructuring, which you don't get every quarter, but we did get in Q2. With that Bitcoin impairment and restructuring and layoffs. And I've got a bunch of other stuff below the income statement, which is...
All right, so when do you forecast Texas to get into break even? And how many deliveries must that happen?
So why did I start with gross margin percentage? It was because you can see... for total Texas, if you run across here, losing money there in Q2 of 2022, making a tiny amount of money there in Q3, right? So that's 3%. Then in Q4, they'll be at like a 12% gross margin for the factory, even though semi is going to come in losing money hand over fist. So I'm forecasting a negative 446% gross margin for the semi. That then becomes a smaller loss and a smaller loss and a smaller loss. And then by the end of 2023, we'll be barely profitable. And then from there, it'll make more money as time goes by.
That's for semi. Okay.
Yeah. So that's what's going on there. So will Giga Austin get very profitable? Yes, it will over time as the price of FSD goes up. Is it going to come roaring out of the gate with giant profitability? I don't expect it to in my forecast.
Okay. And then you've got deliveries. You feel like your delivery estimates by week are... Well,
you asked an interesting question, which was how accurate have your forecasts been in the past? Mm-hmm. So I wanted to share, if you can still see my screen.
Yeah.
Tweet here that shows how my forecast did when I tweeted on November 1st, 2020, what I thought the earnings were going to be for full year 2021, which is the most recent full year we've got.
Yes.
So if not for the $340 million worth of one-time payroll taxes on Elon's stock compensation, I would have been within $27 million for the full year at the non-GAAP earnings line.
Which is how much?
I said is
what's the full year?
Close enough for me. So what I had in my forecast was $8 billion worth of non-GAAP earnings.
Wow.
And what Tesla actually reported was $7.640 billion.
Wow.
Because that that unexpected payroll tax came through. So without that, the rest of these variances would have all netted to almost zero.
Nice.
Now I got lucky in 2021. That's plenty close for a full year forecast. But the point here is Wall Street analysts in November of 2020 were not forecasting this. Their earnings estimates were a lot lower than this.
Yeah.
And they're not doing the same kind of detailed forecast that I'm doing.
Yeah.
Draw from that what conclusions you will. But I follow Tesla very closely, and I update my model all the time with what I learn following Tesla news and,
right.
Following really informative Twitter accounts, etc.
This is brilliant. I just really appreciate you did this. So can we get to what's next? Can we do earnings forecast? I think the big one. Can we get right to that one?
Let's bring back up the model.
I want to know. I can't see these numbers. They're a little too small. Is there a way for you to?
I can zoom in more.
Or do you have the graphs?
Yeah. So here's my income statement, or we can go back to the graphs. Yeah.
Yeah, I see that.
I've got that too. Yeah. So yeah, these are the earnings we were talking about.
Okay, so
a minute ago.
Yeah, go ahead and just, I can't see them. They're a little small for me. So go ahead and just say, what are the earnings that you're expecting for the second half of this year, Q3, Q4, and then all of next year?
Well, I guess I do have to bring this back up to do that then. So the first way that I forecast the income statement is the way Tesla reports it. And I'll zoom in here so we can see these numbers better. People on their phones right now are saying, James, please zoom in. Tell me when I've zoomed in far enough.
Oh, I think you need to keep going, buddy.
Need to keep going. Okay.
I think so. There you go.
That's better. That's enough. Okay.
Yes.
All right. Well, so I'm looking at a 4K 70-inch ultra high def monitor here, so I can't tell how far in I need to zoom for stuff. So here's what I'm forecasting for Q3 and Q4 of 2022. And you can see what I've got into next year. Also, a lot of people who are doing high-level forecasting are not doing it by quarter and projecting out to what next year will be by quarter, right? They're probably just doing the next quarter, and that's it.
I see, yes, correct.
So that's one of the things that you can get following me on Twitter and reading through my forecast threads is what I'm expecting in the near future.
Yeah, and so these earnings, how do they compare to, I don't know, let's say the other estimates that you've heard from other retail analysts and then the analysts in general, institutional?
So this is the income statement as Tesla will report it here. I have to scroll down farther to get to the number that Wall Street cares about, which is the non-GAAP earnings estimate. Yeah. So past some other stuff I need to forecast to get to it.
There we go. Okay.
So what I've done already is adjust for the 3-for-1 stock split that won't happen until next week.
Okay. Yes.
So for full year 2022, I'm forecasting $5.30, which pre 3-for-1 stock split would be $15.90.
Wow.
Right. But we're going to have to start getting used to the post-split numbers because they're coming fast.
Let's keep talking pre-split because I think none of us have adjusted quite yet. And so how does that number compare to, let's say, Gary Black and what he is estimating for his earnings forecast, which I think was around 12?
So, yeah, he's usually lower than I am, and he explains that as me being too optimistic. And sometimes he's right, and sometimes my number has to come down. But as we just walked through, that forecast that I tweeted out, the last forecast that I sent before 2021 began was real close to what 2021 actuals were.
Yes.
So I'm not always pie-eyed and too optimistic. In the case of 2023, I've already adjusted this for the 3-for-1 stock split to $11.72. That's a big number for next year.
$30.
Yeah, 33. So I've been forecasting 32 until recently. This has come up a little bit. One of the reasons for that is the U.S. Inflation Reduction Act of 2022, the humorously named Inflation Reduction Spending Bill. Hey, what's a little more deficit spending, right?
That's what got us into trouble in the first lap. Let's do a little bit more.
What's a few more trillion on the national debt? Come on. Tesla will be one of the biggest beneficiaries and winners as a result of that bill because it's not just a consumer EV tax credit. It is that, but it's a bunch of other stuff too that Tesla will benefit from. There's benefits in there if you produce solar panels. There's benefits in there if you buy and sell batteries or battery packs. There's benefits in there for people who make stationary storage for sustainable energy generation and storage. So there are tax savings that Tesla can reduce their tax expense as a result of that bill. So now there are limits on that. So don't go crazy thinking that Tesla's tax liability will be zero corporate income tax. That's not what I'm saying, but it will be probably only 75% of what it would have been without this bill. So that's significant savings. Those are billions of dollars that are going to flow to Tesla's bottom line as a result of that bill that wouldn't have otherwise. So that's part of what has increased my earnings projection for next year. I forget where Gary is, but it's not over $30 for sure.
This is pretty cool. 33, 15 now, and 33 next. And then, but you did say that a lot of your estimates included take rate for FSD. So currently, I think that number is 15% of buyers of subscription. And what do you see that's growing? Because that could be way off, right? That's the one that could be truly way off.
It's not easy to get that information. What we have is stuff like what Troy Teslike does. I support him on Patreon for providing really valuable information from his buyer survey. So he has Tesla buyers who fill out surveys that explain which options they bought, which is a very handy resource for somebody like me to draw from. But there is sampling bias built into it, or reporting bias, I guess you would call it, which is that not everybody is going to fill out Troy's survey when they buy a Tesla. Most people won't. And there may be differences between the kind of people who would fill out that survey versus those who wouldn't. So I use it as a directional guide, and it's very helpful for stuff like knowing. And sometimes we hear from Elon stuff like the China FSD take rate is very low. It's 1 or 2%, right? So when you're doing a forecast like mine, you really want to factor that in so that you can do a better job forecasting quarters where there's a big change in how many deliveries you're getting from vehicles produced in China, right? Not that every vehicle produced in China is sold in China. Maybe half their production gets shipped to Europe still.
Well, beta's not available anywhere else other than the U.S. and Canada. So that's, I mean, why would I buy it if beta is not available yet? So.
Yeah, that makes sense. But a lot more people in the U.S. were buying FSD beta than 1 or 2%, even before FSD beta was available in America. So Chinese consumers are taking a wait-and-see approach to this technology. They're going to want to see it proven, it seems, before that take rate increases a lot. But I do have it increasing over time as it rolls out, because that's cool technology. That's a cool party trick to let your car be able to drive itself, and that has value. And people around the world are going to see that value and sign up for it.
Yeah, so $200 a month or $12,000 per year, but that's a significant bottom line impact to the margin if you can get more take rate. And that's why I guess it's critical. It's so critical that what happens with the beta and how impressive are people impressed with it. And we don't even need to get to robotaxi, right? We just need to have it to be valuable enough for folks to want to spend that money. And so you're saying that you are seeing a huge impact to the bottom line and to therefore the stock eventually significant. This is significant. Just the FSD beta rate take rate.
So you've got two virtuous business dynamics happening at the same time going forward, which are that the price of FSD is going to go up, and at the same time, a greater percentage of people, Tesla owners, are going to buy it. So the reason for that, one of the reasons for that, is that people who didn't buy FSD at the time they took delivery of their vehicle have the option to buy it as an over-the-air upgrade later. So many Tesla owners are going to upgrade to FSD once they see it working so well that they decide to pull the trigger and buy it. So it's not just related to how many new Teslas you sell. I do expect that take rate to increase over time. More and more new Tesla buyers will buy it, but also more existing Tesla owners who didn't buy it when they bought their car will get it over the air.
Anecdotally, I've got two brothers. We all have Teslas. My sister does not have a Tesla, and she may not buy one. They're very much ingrained in BMW and Mercedes brand loyalty. And I'm the only one that bought the FSD beta. But the other two have been asking me quite regularly, should they buy it? And my second brother, he is on the fence. He's about to buy it, and he sees that this is going to happen, and he wants to lock in the $12,000 price. But my third brother, I told my third brother, they're not quite yet for him. I don't want him to be disappointed, waiting another year, 2 years for something. But what I've been telling people is that, let's assume that this FSD is going to take many more years than we're all expecting. Let's assume that it will be 5 years from now, or let's say even 8 or 10 years from now. Let's say 8 or 10 years. I'll give you that. But in about 3 to 5 years from now, people will start to see that it's going to happen. Like, it's going to be clear. They're going to see the light at the tunnel. And at that point, the value of FSD will go up, even though it's not necessarily there yet. Robotaxi is not there yet. I don't know if, you know what I mean? Like this, at this point, no one is assuming that FSD is going to even work. I think I'd say that only 10% of people are in that camp that think that it's going to happen. 90% is, it's making mistakes every single day. But in 5 years, almost probably 75% of people will go, this is going to happen now. I better lock it in, even though it's not available yet. So
I don't have any robotaxi network revenue or earnings built into my model.
Nice.
But if that happens one day, that's just gravy on top of the earnings growth that you see here already.
Okay.
So what might happen with the FSD take rate is that it goes to 100% because the demand for Teslas outstrips their ability to produce by so much that they can do it.
Or safety.
I think it's required that you have to buy FSD to get a Tesla, then the take rate goes to 100%. Or if Tesla needs to take a significant fraction of production for the robotaxi fleet, then those vehicles aren't available for sale at all, which further limits the amount of production available to sell to people. And at that point, it's even easier to say, well, you have to buy FSD or you can't get a Tesla. And as you just alluded to, and I cut you off immediately. Sorry, Herbert. It's kind of a safety imperative at some point when you say, hey, FSD is proven 5 times safer or 10 times safer than a human driver. It would be irresponsible of us to continue selling these as manually driven vehicles that are 5 times likelier to kill somebody than if they run on FSD with no steering wheel or whatever.
I think it's even simpler than that personally. So, for example, they just recently released the feature, right, where the seatbelt tightening, and the airbag deployment doing it earlier because of the unique ability of the Teslas to have vision, right? That's released. That's coming out. But like, imagine if you don't even have to buy. If you bought FSD, it has a feature that it will prevent you from having an accident. You're never going to, run over or hit a tree, and it'll stop you safely. Just that safety feature alone, it becomes an imperative that everybody needs to buy this, even if you're not promising robotaxi.
Yeah. Now, the world is a messy, dangerous place where accidents do happen. So I don't want anybody to think the accident rate will ever get to zero for Teslas, because stuff happens. And if somebody really wants to hit you with their car, there's only so much you can do to avoid that accident. If you're stopped at a traffic light waiting for it to turn green, somebody can hit you. I've been in an accident like that before. So it'll never be zero, but certainly FSD has the potential to be safer than a human driver in the future. Elon's been telling us for years, and he has a team hard at work making it happen.
Okay, so it's good to hear that your forecast it's kind of like that. It feels like to me like an in-between ground, which is very realistic, right? There is this overly optimistic folks like me who say, oh my God, can you believe when robotaxi comes in and bot comes in and, you know, all these amazing things are being added. And then there's people like Gary Black, who's very conservative, and I think he does add in the FSD take rate, but he's very conservative about that, I think.
Yeah.
And then there are people the general analysts, who don't even put any of that in there and assume it's going to be zero. And then, of course, they undercount the even production, which I don't understand why they do that when it's clear that we have proof from 2 factories, and now you have 2 new factories, and yet they seem to not just, do a straight line of what it's going to happen. They're not taking Tesla's word for it. They're going to take a wait and see approach, and after the earnings have happened, after the gross margins have been reported, then they'll think about maybe taking their earnings forecast up and their price target up. Let's I want to come back to that topic later. I want to deep dive into the analysts, but let's continue on. So you've shown us vehicle production by make, by that's ridiculous. I don't even go through it. By make, by quarter, by factory. I mean, it's okay. You've shown us the earnings forecast, and you told us that it's actually much higher than we've been hearing most folks, but yours is based on really detailed, kind of all the line items added in there. We looked at gross margin, did we? And the cash?
So you can find gross margin here.
And tell us why gross margin is important.
This is the size of your shovel. Nice way to put it. Come on. If you've got a hole that needs to be filled in, you want a big shovel, because the job goes faster if you have a big shovel instead of a small shovel. Mm-hmm. So what you see with gross margin growth here is it's just the revenues minus the cost of sales. So what's cost of sales? These are the costs that are directly related to producing the stuff people are buying. Mm-hmm. So whatever the people got for their money when they handed over all this revenue to Tesla, whatever the costs were that were directly associated with producing those products gets counted as cost of sales. So all the factory costs, all the raw materials a factory needs to buy, all the parts you get in from suppliers, all the labor run at that factory, whether it's hourly or salaried, that's a cost of production. So you've got a gross margin percentage here, which is comparing those against each other.
Yes.
Saying, hey, how much is this cost of sale? Because these are just dollar amounts. Dollar amounts by themselves don't tell you very much. You want to make business metrics out of these to get a better feel for how it's trending over time. And the year started off really nicely with a gross margin at 29.1 and then dipped to 25. Well, we know what did this. Tesla's most profitable factory is in Shanghai, and it was shuttered for 4 weeks for lockdowns, and then running at very limited capacity, 1 shift per day, 6 days per week for a couple of weeks. So that's what brought down the gross margin percentage, because more of the vehicles from Fremont were being sold as a percent of sales mix, and a smaller percentage of the vehicles produced at Tesla's most profitable factory. Yep. But then that's going to improve in Q3, and it's going to improve more in Q4 as mix improves. So you still got some costs here of inefficiencies from like Berlin and Austin that are weighing against your margins. But then by Q4, those should be above break-even volume and contributing gross margin dollars. Yep. So this number is going to continue going up over time. These are the numbers that I'm forecasting for next year.
Let's look at the gross margin percentage. 29% in Q1. And then wasn't it even over at 32% the quarter before?
So let's see. The prior few quarters were like this. Now, this quarter was aided by a lot of regulatory credit sales. So if you want to look at a different metric for gross margin, I've got one here that shows automotive gross margin percent only. So these may have been the numbers you were thinking of.
It is, yeah.
That's so 32, 27, 30, 20, 32, 5.
Okay.
The one up top includes energy and services and other. This one is just the automotive cash sales and leased sales.
Yeah.
And then this is the portion of that owes to regulatory credits. So if you back that out, this is Rob Mauer's favorite metric here, the automotive gross margin excluding regulatory credits. This is the first number he wants to see when Tesla reports earnings.
Yeah. So it's crazy already at 30% to consider that an automotive manufacturer can even achieve 30%. I thought I've seen that the other OEMs are at 12% or some number like that. But at 30%, and it looks like it's going to grow. And once Texas and Berlin are actually, the problem is by that point, they might be building new factories. And so,
Well, I don't expect any new factories to open in 2023, apart from the one in Shanghai. I think that one might open by the end of the year. But these are going to improve over time because the price of FSD will rise, the take rate will rise, and Fremont will become less of the sales mix over time. Mm-hmm. So it's the most expensive place to build cars. You don't want to build cars in California. That is a boneheaded, dumb move that Tesla made 15 years ago because they were just starting out a car company and they wanted to duplicate the T0. And they said, this is going to be easy. We'll open we'll open a little car factory. That'll be fun. California labor laws make it difficult to make a lot of money in a manufacturing business in California. But Tesla figured out how to do it. Like, maybe that's good that they had to figure out how to make money even in a California regulatory environment producing cars. Because once you've done that, it is easy to make money in China or in Texas or in Berlin. Once you get past the red tape in Germany, it's going to be a more profitable factory than Fremont will.
Well, it's amazing to see it go up to 30. Am I reading that right? 37%?
Yeah, 37.5.
That's crazy. And that actually it's not crazy because it's based on your numbers, but 37%. It can happen.
It's a big number for sure, but Tesla is increasingly becoming a manufacturer of hardware and software, just like Apple, right? You can get really nutty gross margin advantages over your competition when you have premium pricing power and you can deliver value in the form of software. So if you go buy one of those 12% margin Fords or Chevys, you are not getting Tesla software in that vehicle. Nothing close to it, right? Have you ever tried to set the navigation destination in a Toyota Prius? I have. I'm good with computers. And it took me a solid 5 minutes to even figure out how to, I couldn't believe the way that I had to do it was the only way to do it. Maybe there is some other way, but I couldn't figure out another way to do it. You have to type in the street address on the keyboard on the screen, right? It takes forever. In a Tesla, you just hit the right button on the steering wheel and you say, drive me to wherever you're going. And it brings it up on the screen and you tap it and off you go if you have FSD beta like I do. it'll try its best to drive you there. As Holmar's blog pointed out on Twitter last week, a Tesla with FSD beta is the only kind of car that can try to drive you wherever you're going.
Yeah.
If you get into that Waymo in San Francisco and you say, hey, let's go to Oakland, it'll say, error.
Yeah.
That is not within my geofenced area. I cannot cross the Golden Gate Bridge because that is not programmed into my computer. So if you get into a Chandler, Arizona autonomous car, you better want to go someplace else in Chandler, Arizona, because that is the only place that car can take you. Most people don't want to go somewhere in Chandler, Arizona, so that's a problem for them.
Yeah. Quick detour here, since you brought it up, but insurance, have you priced in the Tesla insurance? And then also, do you have some estimate of when you think that they might be able to move more to a subscription model? Because if software and additional services take up more price than the actual car itself, and then you can always lease it anyways, and then you add in insurance, and then you add in FSD, and then you add in maybe entertainment or something like that, like this idea that they're going to switch to a subscription model. But what's your thoughts on that?
Yeah, so insurance is one of many things chucked into this services and other revenue group.
Okay.
So here's how much revenue was reported in total. Now, this includes sales of used vehicles. This includes, of course, the service centers, repairs not under warranty are shown here. The Tesla store merchandise, whatever they sell on that store.
Really? You're crazy. Yeah, this is amazing.
A bunch of other stuff is in this bucket because that's the only bucket left, right? So you've either got cash sales to buyers, you've either got lease payments on people who are on, usually it's a 3-year lease, or you've got energy generation and storage products. And if it's not any of these things, it's that. Yeah. It's services and other. So that's where the insurance is. It'll grow over time. Same as I expect the used car sales to grow over time. Same as the repairs not under warranty are going to grow over time as the fleet ages. More of those vehicles are coming off warranty. My 2018 Tesla Model 3 is going to come off warranty for most of the car's components in December of this year. So I better schedule my follow-up appointment to get a checkup before that warranty coverage expires. Make sure it's tip-top. You don't want to have something go wrong with your car 1 month after your warranty expires.
Yeah.
That you could have brought it in for. But that's where that is. And I got the costs here as well. Tesla was profitable on this line in Q2, and I expect them to continue profitable operation of services and other going forward, but not a huge moneymaker in my forecast anyway. I'd be happy to be wrong.
Yeah, no, that's good. That's good to know. I mean, insurance is one of those additional things we're all watching for, but it's going to be a slow growth. Curious to see when you think it'll actually make a material impact, but it looks like it's way beyond 2025.
Well, you're not going to improve your gross margin percentage by adding the insurance business to it. Insurance is not a crazy lucrative business. Sometimes people think I should go start my own grocery store, or I should go start my own airline. And those are terrible ideas. Don't do that. If you're trying to think of a new business to go start, the existing companies that have survived in those markets have razor thin profit margins, like they are barely getting by. And the costs, the barriers to entry are very high to get into those fields. So you do not want to try to compete against the existing players in those fields because it's doubtful that your company will survive. All the same stuff that people told Elon Musk when he said he was going to start a car company and he was going to make electric cars. Yeah. They told him that was stupidity squared.
Yeah, maybe the way to look at insurance is not that it's going to be a impact to the revenue and bottom line, but it's going to change significantly the value proposition of a Tesla and therefore increase the sales of Tesla.
Yeah, assuming that Tesla does a really good job with it, and it sounds like they are already with premium pricing based on your driving history. That's something that other insurance companies can't offer. So that's a differentiator for Tesla, and they are the provider of the repair. So that gives them an advantage over insurers who need to provide a profit margin to whoever is repairing vehicles that they insure.
Yeah, so, I mean, most of us are paying $2,000 a year for insurance, and if you can cut that in half, Metromile is one of the reasons I switched to that. But this is, Tesla's going to be better than that, and so it's going to be very, very compelling.
Yeah, Tesla charges a lot more for components that are replaced than their cost for those parts. So there's some opportunity there to offer your own insurance at better rates than regular insurance companies can compete with.
Yeah,
but not an easy business to get into, and every state has its own laws, which is why the rollout has been very slow for insurance. That's one of the barriers to entry for getting into insurance is you have to hire an army of lawyers and accountants to figure out how to comply with each state's or each jurisdiction's laws that govern selling insurance.
Okay, let's get to cash. My favorite thing, cash.
Well, I can save you some time there. I don't forecast cash. So I forecast the income statement and not the balance sheet. But my expectation for cash going forward is that it's going to be piling up. Well, let me show you what I do have. I do have something here that I can show you. So I do have this chart on free cash flow. So what is free cash flow? It's the total operating cash flows, which is the entire bar here. This is your total operating cash flows minus your capital spending. So these gray bars here are how much money Tesla spent on capital in each of these quarters. And I only have actuals here. There's no forecast because this is not something I forecast. But the white bar underneath it is what's left over after paying for the capital. So out of this free cash flow, that's spending money that Tesla can go spend on whatever they want, right? So during this time period, from here through here, Tesla put up 2 big gigafactories and paid down over $6 billion worth of long-term debt early, and their cash balance didn't decline. So how did they do that? They funded it out of these white bars. That's how they spent this operating cash flow. Now that there is no more recourse debt to pay down, like it doesn't even round to 0.0 billion anymore. They've paid it down that far. They'll never be totally rid of all long-term debt because there's, again, accountants and lawyers who determine that there always has to be some, revolving credit facilities or whatever. The cash is going to start building up unless Tesla can find something else to spend it on. There's not a lot of huge factories still being built. Now, there is work going on in Austin. You can follow 4K Podcast to get updates on that regularly. But the capital spending shouldn't be a lot more than these going forward in the near term. So maybe that money just piles up until Elon decides, all right, time to build some more gigafactories and spend a lot more capital.
Yeah, of course they will. But like you're showing here that they can do all of it. They can keep spending on as many gigafactories as they want, and yet they keep making so much cash that they can't spend it as fast as they're making it. So
yeah, and I'll run you back to the P&L to show you there is this line here called interest expense. And to back this up a little bit, this number was higher in the past, right? So back in 2020, these interest expense numbers were bigger because Tesla had long-term debt payments they were having to make that were large. And going forward, here's the most recent couple of numbers. I've got that decreasing further into the future. When you don't have to pay rent on money, you've got more money. I feel like Dave Ramsey saying stuff like that. But don't pay rent on money if you don't have to. If you can be your own bank, that's more profitable for you than borrowing money and paying interest on it. But it's normal. Like, it's very, very normal in corporate America for Fortune 500 companies to have a lot of debt. Stockholders don't mind when you take out a lot of debt, because the assumption is, okay, you're borrowing money at 3 or 4% to invest in projects. They're going to make 13 or 14% annual returns. Hey, there's 10 points worth of delta on that. That's profit for me. So I want the company to borrow that money to invest in that project to make the extra profit, because if they don't borrow the money, they won't have the money to do the project. So most investors are fine with companies having a manageable amount of debt. But if you've ever looked at the automaker's Altman Z-score, which is a measure of financial strength, you have seen that they are all below 3, which is the gray zone. A lot of them are below 1.8, which is the danger zone. That is the red zone. Tesla's at about 20. Like, Tesla is so far from going bankrupt. That was the war cry from Tesla Q years ago. Was that Tesla was going to go bankrupt imminently. Like, you can find tweets still that haven't been deleted from the same haters who were on Twitter today saying that Tesla was going to go bankrupt right away. And Tesla is one of the financially strongest companies in the world today, and that's only going to become more true as time goes by. And it's a joke that Moody's and S&P have not upgraded Tesla to investment grade.
Yeah. I love it, James. Thank you so much. Let's see. We've got another 20 minutes here. Let me get right to this. I want to get your opinion on this. Let me share this stock price. I'm going to remove this, I think. Oh, sorry. It's taking me a little bit there. I'm trying to figure out how to share my... There it is. Sorry.
It's all right.
Okay. Here we go. Okay. So this is a table that I put together around June of this year. And I just noticed that it's for fun, like you were saying. We don't have to necessarily put a lot of stock, pun intended. Yeah. On something like this. But so this is, I just took a look at the past history and noticed that there's a pattern that it seems that the Tesla stock price is almost always an all-year low on the first half of the year, and the all-year high is at the second half of the year. And it happened in 2019, happened in 2020, happened in 2021. And so then the question is it going to happen again in 2022? So I think this is the first time I'm showing you this, but, curious to see, what your thoughts are. If this is just voodoo, it just happens to be a unique, fun pattern, or is it because my explanation would be that, here's a company that is basically getting its legs underneath it and building factories, producing cars, like you said, in 2018, almost went bankrupt. But since then, after 2018, there's just simple math that you can see that every quarter they're increasing their earnings, cash, sales, everything's going up each quarter. And what I noticed is that, Q1, Q2, they're starting to show that they're continuing to do that. And then Q3, Q4, people start catching up. Gary Black sent a tweet and said that this is a real pattern. And he says the reason it makes a lot of sense is that in the second half of the year, the analysts start to look at 2023. So the analysts right now, and as the months go on, will start looking forward-looking 2023. And when they estimate the earnings for 2023, then that's when they start to increase their estimates and so forth. So what's your thought when you see something like this, and what's your explanation?
So many thoughts. So first, yes, I remember seeing this when it was on Twitter, because I think Dr. Earl Banning, who you recently had on your show, interviewed 28 delays later on Twitter, Earl of Front Puppy, commented that he didn't understand what was going on. And somebody replied, replacing the rockets with dog emojis.
That's me. That's me.
Oh, you did.
Yeah.
And he said, thanks, makes perfect sense. I've heard about this dynamic before. Rob Maurer went into it in one of the episodes of Tesla Daily, which if the viewers aren't listening to Tesla Daily, if you're big into Tesla stock, you should be watching Rob's daily Tesla videos for sure. He went into the January through May versus June through December average stock price increases by year, going back 4 or 5 years like this. And there was that pattern where not much happens, or maybe there's some negative return January through May, and then the second half of the year the stock really takes off. So I'll share my opinion with you that when you see a pattern like that, either it's going to keep happening in the future or it won't. That's my take. Now I know that's not helpful, but I'll explain why that's my take. It's because the stock market has more algorithm trading bots working on it now than it ever has before. And what they're doing is daily trading and arbitrage, but they're also looking at longer windows as well. And they're trying to find patterns to exploit. Anything that's a trustworthy indicator of whether a stock will go up or down over any period of time, those bots are going to use, machine learning, neural nets, whatever, to try and figure that out and remove it from the equation. So what you see with Tesla's daily stock price movements is random movement. It'll go up or it'll go down, and there's just no predicting. Apart from breaking news that comes out that nobody expected, there's really no knowing on any given day whether the stock will go up or go down for that reason. It's because anything systemic has been removed from the system, so all that's left on the short term is randomness. So take it back to a Benjamin Graham quote. In the short term, the stock market is a voting machine, and in the long term, the stock market is a weighing machine. So what does that quote mean? It means the earnings will out. Over time, the earnings growth is what matters. The market should be forward-looking. It should not be backward-looking. So that's my take on this. And if you want to put another explanation behind it, here's another one. I heard the one that you mentioned from Gary. He may also agree with this take, that over the first half of the year, fund managers are looking for alpha. They're looking to beat the average market return. And by about May or June, they start to sweat if they're not keeping up with the market average return, right? So the ones who are winning don't change their portfolio positions, and the ones who are losing versus the average market return do. They change up the game plan like you would if you were losing a football game at halftime, right? They say, hey, my plan didn't work. So far this year, either I'm going to give up on this strategy or I'm going to see it through to the end of the year if I believe in it. One popular strategy among those losing is to say, hey, where can I get a lot of bang for my buck? Well, let's try Tesla. Tesla sometimes runs up a lot over the second half of the year. So I'm going to shift my investments out of other things and into Tesla. And the more of them who do that, the fewer shares there are available, the higher the stock price needs to go. It's just supply and demand.
I love these. Very nice.
But having said that, this is for entertainment purposes only. And
Agreed.
Nobody here is guaranteeing that Tesla will continue to rise in stock price over the second half of the year every year, because that seems unlikely to be true every year going forward, right?
Okay. Can I get you to take a guess at what you think the stock price will be by the end of this year? Are you able to give me some guess? And this is separate from all of your incredible analysis that are very based on actual facts and truth. This is just your guess. What's your expectation?
Well,
barring economic.
When I did my 3-for-1 stock split adjustment in my earnings model, I did see that at the end of Q4 2022, Stephenson Indicator will pass 420.69.
Which is
I'm gonna have to. Yeah,
it's going to be an all-time high, 1,300 or something like that, right?
Yeah, so that would be 12.
20 times 3,
61-ish.
Close to 1,300.
Yeah, somewhere in that neighborhood. So I would, if you're going to put me on the spot for a year-end prediction, a New Year's Day Tesla stock market will be closed on New Year's Day for the holiday. But right around that time, over 420.69 is what I'll say, because that's entertaining to say on a video.
It's fun. But what I say is that it won't be on New Year's Day. It will be on January 4th, 5th, or 6th, because they're going to show the print on January 3rd for Q4 numbers.
Oh, all right. Yeah, that's right. Yeah, deliveries get reported on the 2nd, probably. So
yeah, people are going to be blown away, I think, just like they did last year. Remember in January when people were just amazed at the production numbers that they keep putting out. And by then, I'm expecting Texas and Germany to be hopefully even beyond your estimates, hopefully, right? If they just keep overperforming.
Yeah. My goal is never to estimate or to forecast something Tesla can't beat. I want there to be an equal chance that Tesla beats or misses what I'm forecasting. If that's the case, then I've done my job as a forecaster.
Well, let's start. I wanted to ask you this question about your opinion about institutional analysts. What's the reason why they estimate the way they do? How do they compare to actuals? And I was joking around with you earlier, and I was like, can you find me some sort of metric that whenever I see the average institutional analyst estimate, I can just do a 4 times to that, and that's the actual? Is there a pattern?
Yeah. There's some good analysts out there for sure. If you go to tipranks.com, you can find star ratings on the past performance from analysts, which is no guarantee of future results, but it does tell you who has been doing better at stock recommendations, buy or sell over time. And some of them are pretty good, but the favorite example I have is going back to, 2018, 2019. The highest stock price estimates, the highest one-year price targets in, mid 2019 were $500 for Tesla stock, pre 5-for-1 split. Mm-hmm. So $100 post-split adjusted. And by the time a year had passed, Tesla was over $2,000, right? So 4x the highest analyst expectation.
Yeah.
Now, run-ups like that don't happen every year. You're not going to get a 4x or an 8x or a 10x or whatever happened that year every year, because math doesn't work that way. Law of big numbers, the larger the market cap gets, the harder it is to keep multiplying it. There's only so large fraction of the economy you can take before you run out of room to grow your market cap. But Tesla is not close to that number right now. Tesla has room to run for a while, particularly if they can figure out that humanoid robot, which James Dalma sure thinks they've got the best chance of any company on Earth to figure out with everything they know or are learning about full self-driving. It's basically the same problem. Solving for real-world AI is what you need to be a car on a road or to be a human walking around a physical environment. I know I was going somewhere with this. Yeah. So those analysts and their expectations are based on what they can present with a straight face. So the only people who went way out on a limb saying Tesla is going to grow by a huge number that I recall were ARK. So ARK Invest, Kathy Wood had a $4,000 price target on Tesla, which if you do the split adjustment on it would get to 800. We're above 800 now, right? And that was, I think that was a 5-year target back in 2018. So Tesla got there, and they were right on Tesla, but they were all by themselves. Like ARK Invest is not an analyst that would be ranked on tip ranks. So what I said earlier was right. about the buy-side retail analysts and their consensus. Nobody thought Tesla would go higher than 500 back then, and it blew past it by a huge margin. So, when you talk to Gary about trying to get his earnings estimate up for the future, he says, hey, I have to convince these Wall Street analysts, and they don't want to budge from where they are. They want to ground their assumptions in what has already been demonstrated, and they don't want you to push their thinking outside of that envelope. And for some analysts, he's right. I think others are closer to where retail analysts are on Tesla, believing the product roadmap and the economic benefits Tesla will realize with software and with pricing and with global growth.
Yeah. No, thank you for that. I mean, so first of all, in order for an analyst to be even close to accurate, they need to understand the business. They need to be able to really dig deep into the details. And so you are, like you said at the beginning, you are an analyst and you have spent the time. And I was just blown away. I think most of us will be just so impressed with the detail that you looked at it on both the detail level and the big picture. And you know the business so well because you're part of our community and you stay in touch. And yet you're not like me. You're not this, starry-eyed, optimist. You're kind of like still very much as you try to hold yourself to a realistic line, it still grows to this level of, sounds a little bit like a little off, but it doesn't.
I appreciate bullish perspectives. I appreciate watching, Warren Redlick and Stephen Mark Ryan and Bruce Burnsworth and a lot of other folks who have really high expectations for what they think Tesla should be doing and how quickly they can get there. And that's great. That's great to see those perspectives and incorporate them. Just like it's important to see the other side of the trade. I've been very open to challenging the thinking of people who are selling Tesla short on Twitter over the years. And some of them block me as a result of those interactions over time. I've been fortunate enough to have a lot of my expectations proven true, and they can't always say the same about theirs. So what you want to do is make sure you don't have blind spots. You don't want to find yourself in an echo chamber like a lot of people do who block anybody with an opposing viewpoint. That's not what you want to do when you're investing your own money. You want to know more information. Yeah. More information is better when your own money is at stake. That's my opinion.
Yeah, you do probably one of the most, if close to the best kind of approach to always showing the bear's position and then showing their past tweets and then examining it and then explaining your position and debunking some of the false things. You do such a good job of that. I think I'd love it if you're open to it. Invite you to our Cyber Bulls live stream that we do on Tuesdays. And I'd love to have you and Brian from My Tesla Weekend. The two of you do a fantastic job. And we should talk about the bears because we're the bulls. And so we need to have bears. And I'm going to invite bears, but love to get your opinion on that. So thank you so much, James.
Yeah.
Really appreciate this. As I mentioned earlier, James produces these detailed reports. Visit him on his YouTube channel, and his Twitter handle is @ICannot_enough. And consider being a Patreon. This is where we got lucky today. This kind of level detail in the updates he shared with us, just because I scheduled today's call the day after he released it. So otherwise, this is reserved. Really appreciate this, James. Thank you so much. Thanks, everybody. And like I promised, you didn't just get a little brighter today. I think we all got very bright. So thanks, everybody.
Thank you, Herbert.